Money silently controls almost every part of our lives, where we live, what we eat, what dreams we chase, and even how we feel when we wake up each morning. Yet nobody teaches us how it really works. Schools teach equations but never explain credit cards, loans, inflation, budgeting, or investing, leaving billions of people stressed, trapped in debt, working paycheck to paycheck, and confused about why their income never seems enough. Behind the scenes, a financial system operates, where banks use your deposits to make profit, companies design prices to influence your choices, and most people struggle because they never learn the strategies that wealthy individuals understand. Financial pressure has become a global epidemic, destroying relationships, mental peace, and long-term stability, keeping people awake at night not because of fear but because of bills due tomorrow. This documentary exists to reveal how money truly works, from income, budgeting, debt, banking, investing, and inflation to wealth-building mindsets, giving you the knowledge, strategy, and discipline to take control of your financial life, escape traps that hold ordinary people back, and finally build a future where money no longer controls you because now you control it. Human psychology shapes every financial decision we make, and most people lose money not because they earn less, but because their brain is wired with biases that push them toward emotional spending, impulsive buying, fear-based decisions, and overconfidence. We believe we deserve rewards after stress, so we overspend. We chase sales thinking we're saving money, but actually buy things we don't need. We follow the crowd into trends or investments without understanding them, and we panic sell when markets fall because our brain hates loss more than it loves gain. Advertisers study these biases deeply, from colors to placement to emotional triggers, and use them to control your wallet without you realizing it. Cognitive blind spots like the Diderot effect make you buy more once you buy one new thing. Lifestyle inflation forces you to spend more when income rises. Anchoring tricks you with fake discounts, and the illusion of wealth pushes you to copy others, instead of building your own reality. True financial strength begins when you understand that money decisions are rarely logical. They're emotional, and by learning to pause, question, and recognize these psychological traps, you gain the power to spend consciously, invest wisely, and build wealth with discipline instead of impulse, turning psychology from your biggest enemy into your strongest advantage. Income is the foundation of financial life, yet most people misunderstand it, believing that a salary alone can create wealth, when in reality income is divided into three types: earned income, active income from skills or services, and scalable income that grows without depending on hours worked, and only the last two truly build long-term financial freedom. Your earning power depends not on your job title, but on the value of your skills, your ability to solve problems, and how replaceable you are in the market. Which is why two people working the same 8 hours can earn completely different amounts in today's economy. Income doesn't rise automatically with experience, it increases when you upgrade skills, understand market demand, and create multiple revenue streams like freelancing, consulting, online businesses, or investments. Staying dependent on a single paycheck is the biggest modern risk because layoffs, inflation, and economic shifts can collapse your entire lifestyle overnight. But diversifying income transforms your financial stability. The wealthy focus on raising their earning power, learning high-value skills, and turning knowledge into income sources, while most people stay trapped trading time for money. Understanding how income works empowers you to break that cycle, build skills that make you valuable, and create streams of money that move you closer to real financial independence, not just survival. Budgeting is not about restricting your life, but about taking control of your cash flow. Because without a plan, money quietly slips away through small, invisible expenses that accumulate into financial stress. A proper budget tracks three things: how much comes in, how much goes out, and where it goes, allowing you to see patterns that normally stay hidden, like emotional spending, unnecessary subscriptions, and lifestyle inflation. Wealthy people don't budget because they were rich. They became rich because they understood where their money was going and optimized it with intention. The 50-30-20th method, zero-based budgeting, and reverse budgeting are tools that help you assign every rupee a purpose. So, your money works for you instead of disappearing without explanation. Budgeting also exposes the truth about your habits, showing that income is not always the problem, spending choices are. When you calculate your needs, wants, debts, and future goals, you start realizing how much financial peace depends on discipline. A strong budget is a shield against inflation, emergencies, and bad decisions, and it gives you the clarity to build savings, invest consistently, and avoid living paycheck to paycheck. Ultimately, budgeting is about freedom, knowing exactly where your money goes so you can redirect it toward the life you want, instead of the life forced upon you by poor financial habits. Debt is one of the most powerful financial tools in the world, and also one of the most dangerous traps, because it can either build your wealth or silently destroy your future, depending on how you use it. Most people fall into debt not because they are irresponsible, but because they don't understand how interest works, how minimum payments keep them trapped for years, and how companies design loans, credit cards, and installment plans to make repayment feel easy while extending the debt for as long as possible. Bad debt, like high-interest credit cards, personal loans, payday loans, and unnecessary installments, drains your income and steals your financial freedom, while good debt, like business loans, skill-building loans, and real estate financing, can create long-term assets and increase your earning power. Banks make money from your interest, not your success, which is why debt feels comfortable at first but becomes a burden later. Debt also affects mental health, relationships, productivity, and lifestyle because every decision starts revolving around payments and due dates. Escaping debt requires understanding amortization, avoiding minimum payments, prioritizing high-interest loans first, cutting emotional spending, and redirecting freed-up money into savings and investments. The wealthy use debt strategically to grow assets, while the poor use debt emotionally to maintain lifestyle. And recognizing this difference is the first step to breaking the cycle and taking back control of your financial life. Banks appear to be safe places that simply store your money, but in reality they operate on a system called fractional reserve banking, where only a small percentage of your deposits stay in the bank while the rest is loaned out, invested, or used to generate profit, meaning your money is constantly moving even while you think it is just sitting in your account. Every time you deposit money, banks multiply it through loans, credit, and interest-based products, earning far more from your money than you ever will from the tiny interest they give you. The entire banking ecosystem thrives on fees, service charges, loan interest, and investment returns, which is why banks encourage credit card usage, offer installment plans, and make borrowing feel effortless because your debt is their income. Most people don't realize that debit cards, mobile wallets, and online transfers have reduced cash usage not for convenience, but to keep money circulating inside the banking system where it can generate more profit. Meanwhile, savings accounts rarely beat inflation, meaning your purchasing power decreases even while your balance goes up. Wealthy individuals understand that banks are tools for management, not wealth creation, using banks for security, liquidity, and transactions while building actual wealth through assets and investments. Understanding how banks truly use your money helps you stop treating your bank account as a wealth machine and start using it strategically as a financial hub that supports your goals, instead of replacing them. Saving and investing are often confused as the same thing, but they serve completely different purposes. Saving protects your money while investing grows it, and relying only on savings is the reason most people never build real wealth. Savings are meant for emergencies, short-term goals, and financial safety, but saving alone can never beat inflation because the value of money constantly decreases, which means your purchasing power shrinks even when your bank balance increases. Investing, on the other hand, uses time, compounding, and risk to multiply your money, turning small consistent amounts into long-term wealth. Yet people fear investing because they don't understand it, and choose the illusion of safety in savings over the reality of growth. The truth is that both saving and investing are necessary. Savings gives stability, while investing gives freedom. And wealthy people master the balance between the two by building emergency funds, automating investments, understanding risk levels, and letting compounding work for years. The poor stay stuck because they depend only on savings and avoid investing due to fear, losing years of potential growth. Once you realize that money sitting idle loses value while invested money grows quietly in the background, you start shifting your mindset from protecting every rupee to strategically multiplying it, creating a financial foundation where safety and growth exist together. The stock market is one of the most powerful wealth-building tools ever created. Yet it feels intimidating because most people imagine it as a risky casino, when in reality it is a marketplace where companies sell ownership in the form of shares, and long-term investors benefit from the growth of businesses, economies, and industries. The market rises and falls in the short term due to news, global events, investor emotions, and economic cycles, but historically it grows over time because companies expand, innovate, and increase profits, understanding basic concepts like stocks, ETFs, dividends, market indices. And compounding helps you see that investing isn't gambling, it's ownership. Rather than trying to time the market, successful investors focus on time in the market, letting consistent contributions grow over years. Diversification spreads risk across industries and companies, while emotional decisions like panic selling during dips or chasing hype during rallies cause most losses. The rich use the stock market to steadily grow wealth, earn dividend income, and protect against inflation, while those who fear it miss out on decades of potential gains. Once you understand that the stock market rewards patience, discipline, and long-term thinking, not luck, you stop fearing volatility and start seeing it as an opportunity to build wealth by owning pieces of the world's strongest companies. Cryptocurrency and digital assets have transformed the financial world by introducing a system where money is not controlled by banks or governments but operates through decentralized networks, using blockchain technology, allowing people to transfer value globally without middlemen, high fees, or restrictions. Bitcoin, the first and most famous cryptocurrency, acts like digital gold, limited in supply and protected by math instead of institutions, while other coins and tokens serve different purposes like powering smart contracts, decentralized apps, and digital economies. Although crypto offers massive opportunities, it also carries high volatility and risk because prices react quickly to market sentiment, news, regulations, and investor speculation. Many people lose money by chasing hype, investing emotionally, or falling for scams, forgetting that crypto requires understanding, security precautions, and patience. Storing assets safely in hardware wallets, researching projects, and avoiding pump and dump schemes are essential for protection. While governments debate regulations and institutions slowly adopt blockchain technology, crypto continues to grow as an alternative investment class that provides diversification and potential long-term value used wisely. Crypto can become a small but powerful part of a modern financial strategy, but treating it like a shortcut to wealth leads to losses. Its true power lies in understanding the technology, managing risk, and thinking long-term rather than gambling on short-term price movements. Real estate has always been one of the most reliable paths to wealth because land is limited, while population and demand continue to rise, making property ownership a long-term asset that grows in value, generates rental income, and offers financial security. Unlike stocks that move daily, real estate grows slowly but steadily through appreciation, while rentals create consistent cash flow that can cover expenses or even replace your main income. Understanding the different types, residential, commercial, plots, rental units, and rights helps you choose the right path based on your budget and goals. Mortgages and financing allow you to use leverage, meaning you can control a large asset with a small down payment and let tenants indirectly pay off your loan, creating wealth through other people's money. That mismanaging debt, ignoring maintenance costs, or buying without research can turn property into a burden. Location, demand, rental potential, economic growth, and future development plans matter more than the property's appearance. And smart investors study these factors to avoid bad deals. The rich use real estate as a shield against inflation, a generator of passive income, and a long-term wealth multiplier, while beginners often wait too long out of fear or confusion. Once you understand how real estate builds wealth slowly but powerfully, You see it as more than just land. It becomes a strategic financial engine that supports your future for decades. Risk management is one of the most overlooked pillars of personal finance. Yet it is the barrier that protects everything you work so hard to build. Because no matter how well you earn or invest, one medical emergency, accident, job loss, or unexpected crisis can wipe out years of progress in a single moment. Insurance exists for this exact purpose, not as an expense, but as a financial shield that transfers risk from you to a company in exchange for a small premium, allowing you to protect your health, income, family, assets, and future goals. Health insurance prevents medical bills from destroying savings. Life insurance ensures your family stays financially secure if something happens to you. And property, vehicle, and business insurance protect against accidents, theft, or damage that could otherwise lead to massive losses. Wealthy people prioritize insurance because they understand that stability is the foundation of growth, while many others avoid it thinking it's unnecessary, only to face devastating consequences later. Building an emergency fund, creating backups for income, securing important documents, and diversifying investments are also essential parts of risk management. True financial strength is not only about earning and investing, it's about being prepared for the unpredictable. So one unexpected event doesn't collapse your entire financial structure, allowing your long-term plans to stay safe and intact regardless of life's uncertainties. Taxes are one of the biggest and most misunderstood expenses in a person's financial life, silently taking a portion of every paycheck, business profit, investment gain, and property transaction. Yet most people never learn how taxes actually work or how to legally reduce them. Governments use taxes to fund public services, but the tax system is built with rules, deductions, allowances, and incentives that reward people who plan their finances wisely, like investing in retirement accounts, owning property, running businesses, or contributing to government-approved savings schemes. While those who don't understand these rules end up paying more than necessary. Inflation and taxes together erode your wealth faster than you realize, which is why smart financial planning includes tracking taxable income, understanding brackets, separating business and personal expenses, and using legal exemptions to protect your earnings. Wealthy individuals don't escape taxes by chance. They study tax laws, hire experts, use depreciation, claim deductions, invest in tax-efficient assets, and structure their income to minimize tax burden. Meanwhile, ordinary earners often lose money simply because they rely only on salary and never explore government incentives or financial strategies. Once you understand that taxes are not just payments but a system you can navigate, you gain the ability to keep more of your income, grow your wealth faster, and prevent a significant portion of your hard-earned money from disappearing unnecessarily each year. Inflation is the invisible thief that quietly erodes the value of money over time, making every rupee you save today worth less tomorrow. Yet most people underestimate its long-term impact and fail to plan accordingly. It occurs when prices rise across goods and services, driven by demand, supply constraints, government policies, and currency fluctuations. And it affects everyone from salaries and savings to investments and pensions, reducing purchasing power if your money isn't actively growing. The wealthy protect themselves from inflation by investing in assets that tend to outpace price increases, such as stocks, real estate, commodities, and inflation-protected bonds, while relying solely on cash or traditional savings accounts guarantees that your financial security slowly diminishes. Understanding inflation also helps you plan for retirement, set realistic savings goals, and adjust budgets so that lifestyle, education, and healthcare needs don't collapse under rising costs. The key lesson is that money sitting idle is losing value every day, and only by combining disciplined saving with intelligent investing can you stay ahead of inflation, preserve wealth, and ensure that your future is not dictated by the silent erosion of purchasing power. Millionaire habits and mindsets are what separate those who accumulate wealth from those who merely earn and spend, because financial success is not only about money, but about the way you think, act, and prioritize your life. Wealthy individuals focus on long-term goals instead of short-term gratification. Continuously learn new skills, read extensively about finance and business, set clear objectives, and surround themselves with like-minded people who challenge and inspire growth. They view failures as lessons rather than disasters. Invest time in building multiple income streams, track expenses meticulously, and treat money as a tool rather than a reward, making disciplined decisions even when emotions tempt them to overspend. Or procrastinate habits like waking up early, planning daily tasks, automating savings and investments, networking strategically, and consistently improving skills create compounding results over years, just as compounding interest multiplies money in the market. Ordinary people often imitate the surface of wealth, buying luxury items or showing status. But the true difference lies in mindset, patience, discipline, education, and strategic action. Adopting millionaire habits is not about instant transformation, but about creating daily routines and thought patterns that accumulate into financial freedom, security, and lasting wealth over time. Passive income is the cornerstone of financial freedom because it allows money to work for you while you sleep, freeing you from the constant trade of time for money that defines most people's lives. It can come from rental properties, dividend-paying stocks, royalties from creative work, online businesses, affiliate marketing, or automated digital products. And the key is setting up systems that generate cash flow consistently with minimal daily effort. Unlike active income, which stops when you stop working, passive income continues to grow over time if managed properly. And when combined with disciplined investing, it creates a snowball effect that can eventually replace your main paycheck. Building passive income requires upfront effort, planning, skill acquisition, and sometimes initial capital. But the payoff is freedom and security, enabling you to take risks, pursue opportunities, and live life on your terms. Wealthy individuals focus heavily on creating multiple streams of passive income, diversifying them to reduce risk and reinvesting profits to accelerate growth, while most people rely solely on active income, leaving them vulnerable to job loss, inflation, and market changes. Understanding and implementing passive income strategies transforms the relationship with money from dependence to independence, giving you the control to live your life rather than live for your paycheck. Financial freedom is not about becoming extremely rich overnight, but about reaching a stage where your investments and passive income are sufficient to cover your living expenses, giving you the choice to work because you want to, not because you have to. The FIRE approach, financial independence, retire early, focuses on disciplined saving, aggressive investing, controlled lifestyle, inflation, and long-term planning, allowing individuals to achieve independence years or even decades earlier than traditional retirement timelines. It requires understanding your annual expenses, increasing your savings rate, investing consistently in growth-oriented assets, and letting compounding work over time, while avoiding unnecessary debt and emotional spending. FIRE does not mean quitting work forever, but gaining freedom over time, location, and decisions, enabling you to pursue passion projects, family time, or meaningful work without financial pressure. Many fail to reach financial independence not due to low income, but due to lack of planning, patience, and consistency. When approached realistically and sustainably, the FIRE blueprint turns financial discipline into freedom, proving that with clarity, control, and long-term thinking, financial independence is achievable for ordinary people, not just the wealthy. Building wealth is not a single decision, but a lifelong process that begins the moment you choose awareness over ignorance and discipline over impulse. Because true financial success comes from small, consistent actions repeated over years, not from shortcuts or luck. By understanding how income works, controlling spending through budgeting, using debt wisely, protecting yourself with insurance, investing for growth, and staying ahead of inflation and taxes, you create a strong financial system that supports your future instead of sabotaging it. The journey requires patience, continuous learning, adaptability, and the courage to make decisions others avoid, like delaying gratification, upgrading skills, and investing when fear is high. Setbacks will happen, markets will fluctuate, and mistakes are inevitable. But those who succeed are the ones who stay committed, adjust strategies, and keep moving forward. Financial freedom is not reserved for a special few. It is available to anyone willing to take responsibility for their money and their choices. When you apply these principles step by step, money stops being a source of stress and becomes a tool for stability, opportunity, and purpose, allowing you to design a life where your future is intentional, secure, and truly your own.